Good morning, students. Welcome back to the session on Ind AS. So we were discussing Ind AS 37 and we plan to continue with this Ind AS. Before we get on to the new things in terms of discussion for today, let us do a quick recap of everything we covered in the last session. And also there was one illustration on which were a bit stuck in terms of the facts which were available, in terms of the solution which was there. So we'll also discuss this illustration number 1. Alright, or this question number 1. Yeah. So quickly on to Ind AS 37. We discussed first of all about the executory contracts on which this Ind AS does not apply. Secondly, in terms of Ind AS 37, there were a couple of things which are required to be considered. First is about the meaning of liability, because that becomes the basis for this standard. Because this is how we can also try to get into finer details of a provision, because provision is also a kind of liability which has sort of uncertain timing or which has uncertain amount. So the moment we have this uncertainty involved in terms of either of these or both of these, instead of calling an obligation or this outflow of resources as a liability, we start calling it as a provision. And this is how we also differentiate between a provision and a liability. Now, in relation to this provision, there were a lot of things we discussed. So I will not get into details of all of those things currently. The other aspect that we covered was about the contingent liability. So if you want to share any thoughts, you can also share along with me in terms of contingent liability. Now, what was a contingent liability and how is it different from a liability or a provision? For this, as we discussed, there is an analysis which is required to be done. Probable, possible, remote. The moment we say outflow of resources is probable, okay, we have an obligation and outflow of resources is probable. In such a case, what do we create? We create a provision. Means we recognize the amount because there's more likely than not that the outflow will happen. Or we can say there are more than 50% chances of outflow of resources from land. So that's why in such a case, provision is required to be created. The other impact, the other aspect is about the possibility, wherein we are saying that it's a 50-50 scenario. In a 50-50 scenario, what do we do? In a 50-50 scenario, we don't create a provision, means we don't recognize it. Rather, we only give a disclosure, which is in the form of contingent liability. So contingent liability doesn't get recognized. And why do we call this as a contingent liability? Because there's a contingency which is attached to it. And because of this contingency, we don't really know whether this liability will arise or not in future. Yeah, again, it's a matter of uncertainty which is attached to it, and that's why we call it as a contingent liability. The third situation is about the remoteness, or we can say the remote chances of outflow of resources from an entity, in which case none of these will come. Means neither the provision will be created nor the contingent liability will be disclosed, nothing will be done. And that transaction will not have any impact on the financial statements. Correct? Yeah. So with this understanding, we'll just move further today. We'll get into the measurement aspects of the provision particularly. Because there are a lot of things which are attached to the measurement of the provision, and that happens to be another very important area in relation to this sector. Yeah. Is it okay now, Ram? Is it okay now? All right, yeah. All of you, can you please confirm whether the sound is all okay, audio is all okay? All of you, I can see some of the queries from the student now. Sushi, Meena, Tata, if you can confirm, sound, voice, all okay now? Is it all okay? quickly can confirm. Audio is all okay? Ram, you can confirm. I think nobody is responding, so it seems to be okay. Ram, is it all okay? Okay, perfect. So Navneet has confirmed it, Dutta has also confirmed it's fine. Alright, so now we'll move on to question number 1 on page number 9.126. Yeah, so in relation to this question, the facts was slightly sort of confusing, I would say, in the question, and that's why the solution which we discussed in the last session was also not really the one which you would consider in line with the facts which are given in the question. So I'll just quickly repeat the fact pattern which is available in the question. So if you go to this question and if you read the last para particularly, it says that the past history has shown that there are a couple of matters in relation to the matter which the company is planning to contest. And if you look at the history, then the judgments have been one in favor of the company and one against the company. Not this company, but the other companies. Okay, so if you look at the past history, what is the analysis you would get? Analysis you would get is that in 50% of the cases, because it's only 2 cases, so in 50% of the cases, department won the case, and in 50% of those cases, client won the case. That means the company won the case. Okay. But again, this number is very, very small for this percentage to be analyzed. And given the limited fact, we have to go by this 50% only. Secondly, the company was also advised by its legal counsel that the case which the company is contesting, even though there's a historical pattern which the company can see around these cases, it has a good chance. Means the chances of winning are more than 50%, or you can say chances of losing are less than 50%. The moment we say that the chances of losing are less than 50%, what do we do? We don't create any. Yeah, we don't recognize a provision. We don't disclose a contingent liability. But if we go to the solution says that the given scenario doesn't have the appropriate fact pattern. Because if you look at the history, the company doesn't have too much precedence. Okay, only 2 cases are there. Number 1. Secondly, legal opinion is only an advice which is available to the company. On the basis of the legal opinion, it cannot be concluded that yes, of course, it will be given against the company or it will be in favor of the company. And that's why the solution says that the company should create a provision, because it's a case which the company may lose, and that's why it will be appropriate to create a provision. So this is one view which is given. I would suggest that along with this, another view which may be taken could be the one wherein we may go by the fact pattern which is given in the question, and we may go by the legal opinion which is also available to the company, through which company makes an analysis and the management forms a judgment that the management or the company will have a good case, or the chances of losing are remote. In which case, nothing is required. Because if we look at the scenario which is available in the question, in the practical life also, you would have seen a lot of such scenarios, and I'm sure during your articleship or during your assignments. And some of you who may not have been able to work on these type of projects will definitely get to see, because these are all practical life scenarios. And the analysis of such judgments is not very easy to be done. Yeah. So that's why we cannot really say that there can be one answer to it. But for the purposes of us, that means for the purposes of examination, we need to take a basis of concluding this. And that's why another view which you may consider could be the one wherein nothing is required to be created against this, neither a provision nor a contingent liability. And again, this is something which can also justify and explain in the solution. And that should also be considered to be all right. Yeah. I will also discuss this internally and I'll see if any sort of revision is also required in this solution. Okay. Yeah. So I would suggest this is how you can also deal with this type of question in the examination. If you have any more queries other than this, please let me know. Then we'll move on to the next part. We'll now be moving with the measurement part. Shraddha is a query. Shraddha is saying, please clarify in the executory contract example given, isn't it liability? Because the concept may be related to provision, but the example is related to liability, right? So because goods are delivered, Shraddha, it would be helpful if you can just specify the example, because I don't really remember the example you have been talking about. Jamin is saying that in this question, based on the fact pattern, one can always say that outflow is possible. Yeah, which is based on the historical data. Definitely I agree, and that could be the reason why the solution has been picked up. And that's why I'm saying it's very, very judgmental in the practical life. When you get into these real scenarios, it's very difficult to conclude. And generally, companies would take a conservative view of at least considering the contingent liability. But as I told you that for the purposes of your examination, you need to have some basis, because we cannot apply that type of judgment, because we need to have some basis to come to a conclusion. And that's why on the basis of legal opinion, if we want to go with this and we want to consider that becomes the management judgment, then it will not be wrong to conclude that nothing is required to be created in this case. Or if you want to be conservative, we can always say that being conservative and looking at the historical pattern, contingent liability can be considered. That's why I'm saying if any sort of revision is required in this, I discuss this in parallel. Yeah. All right. So now moving further on to the measurement part. So far, we have been discussing all about the recognition. During this recognition, we have also discussed the amounts as to how the amounts will be ascertained. But there is a detailed guidance which is available in the standard as regards the measurement. Or you can say the amount at which provision will be recognized is something which is dependent on a lot of factors. Now, so far, we have talked about provision so much that we understand that provision is not something which is an amount in terms of its certainty. An approximation is important, correct? An approximation is important. Why? Because there is an uncertainty. And that's why we can say it is more about an estimate. It is more about an estimate. What is an estimate? Estimate is again something which is not certain, which is based on approximations. But even if we have to use an estimate which is based on approximations, we have to make our best analysis as regards the measurement of the amount. And that's why standard suggests that whenever we consider recognizing a provision, we should make the best estimate. Best estimate which is possible based on the facts which are available, based on the precedences which are available, based on the expectations which the management may have in relation to that type of transaction, and that best estimate will become the basis of the recognition of a provision. Now, what do we mean by best estimate? Now, the moment we talk about the best estimate, again, we may get into a situation wherein many possibilities exist. For example, we may say that a particular transaction, or let's suppose a particular litigation, may involve a liability in future, or may involve outflow of resources in future. And there could be certain scenarios which are attached to it. For example, scenario number 1 says that it's more likely that the outflow will be, say, 60,000. Scenario number 2 could be that there's a probability of, say, let's suppose 20% that outflow will be 80,000. Yeah. Similarly, a lot of situations are possible, or you can say many situations at times are possible in relation to a particular transaction or an event in relation to the outflow of resources in future. So in such a situation, what do we do? All of those scenarios are required to be analyzed, and a liability, or you can say an outflow of resources or an amount, is required to be determined based on each scenario. So if we say we have scenario number 1, 2, 3, 4, based on each scenario, an amount is required to be determined. Correct? Yeah. And on the basis of probabilities which are attached to each scenarios, we need to assign weights to every amount which is determined. This weighted average will then become the best estimate for that particular type of event or that particular type of transaction. Okay, yeah. Now, this is something which is required to be considered for every type of event or every type of transaction for which we will assess the amount of provision on the basis of the estimates. Okay, correct? Yeah. I think this is something which can be best understood with the help of an example. So that's why I'm just straight away moving on to this illustration number 6 on page number 9.106. Illustration 6. Through which we should get more clarity around this basis which we have discussed. I think it's simple to understand. In the meantime, I've seen this big query coming from Shraddha. Shraddha, I would request you can just hold on to this query for some time. Maybe towards the end of the session we can discuss this. Yeah. An entity sells goods with a warranty under which customers are covered for the cost of repairs of any manufacturing defects that become apparent within the first 6 months after purchase. So there's a warranty which is available for first 6 months. From the date of purchase. If minor defects were detected in all products sold, repair costs of 1 million would result. So if the defect will be minor, then the company has estimated a cost of 1 million. The entities, if the major defects were detected, the repair costs would be 4 million. So instead of minor, if the defect would be major, then the outflow will be 4 million. Obviously, the amount will be higher. The entity's past experience and future expectations. Now, this is again something which is very, very important to understand. Past experience and future expectations. We'll talk about both of them in detail. But you should understand that these are a couple of things which will always be required to be considered for making the best estimate. Okay. These two indicate that from the coming year, 75% of the goods sold will have no defects. So 75%. So third scenario is no defect. So first scenario is minor defect, second scenario is major defect, third scenario is no defect. So what is the probability that the goods will have no defect? 75%. 20% of the goods sold will have minor defects. So this is 20%. So what's the remaining probability? 5% chances are that the defects will be major. Of course, if the defect is none, then the outflow is going to be nil. Right? Yeah. In accordance with the standard, of course, it has to be in case 37 why we will be talking about warranty, and we understand that in relation to this type of warranty, provision is required to be recognized. An entity assesses the probability of an outflow for the warranty obligations as a whole, and let's see how the warranty obligation, or you can say the provision in respect of this warranty, will be determined. And I think it's very, very simple. Can you all quickly compute this? What will become the basis? 20% into 1 million. 20% into 1 million. 5% into 4 million. 75% into 0. Okay. So what is the amount that we will get? The amount that we get is the 4 lakh. Yeah. Now in this scenario, what did we do? We assigned weights. What is the weight? Probability. We assigned weight to the outflow which is expected. Now this outflow is not something which is certain. This is expected. So we assign weight to the outflow. And on the basis of this weighted amount, what did we do? We computed the total amount of provision which is expected in relation to all the goods which have been sold. Yeah. Dana has also got the same answer. Any more responses from your side? I'm sure many of you would have solved this. I think I missed one query. Vijay was asking, so if we choose another way, that was in question number 1, then we have to get clear conclusion. Of course, see, whichever way you choose, your conclusion has to be clear, backed by the basis which you have been considering. And of course, if you are using any sort of assumptions or any of the basis, you should explain it. You should also explain as to why you are considering it. That is always a good. Okay. Yeah, clear on this? Perfect. So I think Kalyani and Shraddha got the same answers. Very good. Anuj, I think you need to check at your end because I understand audio is all clear now. I'm not sure why you're experiencing any difficulty. Maybe you can check at your end, please. Okay, so let's move further. We'll pick up some more examples for this. Okay, so now moving on to example number 24. This is paid. If an entity has an environmental obligation to clean up the drinking water that got contaminated, there might be a number of different ways to carry out this work. Each of these methods would have different probabilities of success and would cost different amounts. In such a case, the entity might choose the method which has the most likely possibility of success. Now, in this scenario, you need to consider that when the entity is going to choose one method which has the most likely possibility of success, then do we need to consider all other scenarios? No. So let's suppose there are various methods of cleaning up the water. Method A, method B, method C, method D. Correct? In such a case, unlike what we have just considered, wherein for all the scenarios we assign probabilities and we attach those probabilities to the outflow. In this scenario, do we need to do that? No. Because when we understand that the management or the company is going to use only one method, that means this method, then the outflow which will be attached to this method, whatever be the outflow, only that outflow should be considered instead of considering all of these others. Yeah. Namita is asking, sir, in practical life, how are these weights assigned? See, in this example, if I go back to illustration number 6, we saw there were 3 probabilities or 3 scenarios: 75%, 20%, and 5%. Yeah. Now, in the practical life, what would happen? In the practical life, these percentages or these probabilities would also be required to be determined by the entity. For you, it is available in the question. But let's suppose if you are the management, if you are the company, if you are the entity who has to estimate this amount, what would you do? You would have to determine this amount of provision, and you would have to determine this probability percentage also, which is very, very difficult and which requires a lot of analysis. And that's why I'm saying there are a couple of things which are required to consider this. One is the historical pattern, and second is the future expectations. And because you just touched on this point, so I'll also let you know as to how this probability will be determined. On the basis of the historical pattern, this is generally estimated. For example, let's suppose in the past 3 years, company has seen that the minor defects range from 75 to 80%. Correct? And the major defects range from 20 to 25%. This is the history which the company has been seeing in the last 3 years. Or let's suppose only 1 or 2% are the cases wherein there are no defects. Now, for the company to determine the probability percentage, we have this data available? Yes. And this data is available in respect of the company itself? Yes. On the basis of which they can now determine the probability for the next year? Yeah. So this becomes past experience, number 1. Now, on the top of this past experience, company would also have to build the future expectations. and which will change the percentage. Let's understand how. I slightly digressed from this topic, but again, this is something which is very much in line. So let's suppose we are looking at the current year for creating a provision, and this is past year 1, this is past year 2, and this is past year 3. Okay, this is the future. Now let's suppose in the past years we have seen 75%, 75%, 75%. Why do we get this 75% or how do we get this 75%? Because this is something which has already become actual. All of these numbers are available with the management. They know that in the past how many cases came to them for review. Okay, so they understand this is the percentage. Correct? Let's suppose 20%. This was major defect. Let's suppose minor was 20%. I've kept the percentage same, but you may also change it. Year on year, you may change it. And let's suppose no defect. Every year was 5%. Now it would become easier on the basis of this data for the management to assess the percentage for current year. So one basis is the past experience, but only past experiences are not considered for assessment of these amounts. It is very important for the management to estimate the future expectations. Remember in the last session also, we briefly talked about it. It is not necessary that the product which is sold year on year remains the same. Maybe the technology has changed significantly, or maybe the technology has changed slightly. Yeah? In any of the scenarios, this percentage may change. Correct? And even if we continue with the same type of technology to exactly the same type of product, it's not necessary that the past pattern will continue in future. It may happen that by chance now the number of defects have increased, or may increase, or may go down significantly. It is possible either way. Correct? Yeah. Third scenario could also be the one, or you can say another situation which is possible could be the one wherein the management will think that in the past years, whenever there was a major defect, cost was 4 million. For minor defect, cost was 1 million. For no defect, of course, this was 0. But with the improved technology, with the revised methods which will be available, with the strategies which the management may adopt in future, they may think or they may assess that going forward, even if it's a major defect, the cost will not come up to 4 million. Instead, it will go down to 3 million. Okay, or it may happen that if it's a minor defect, it's not necessary that the cost will continue to be 1 million. It may increase to 2 million. Correct? This is something which is possible, and this is something which is again dependent on the methods, dependent on the technology, dependent on the entire process which the management knows. So there's a technical team of the company which is always available, who knows about their processes, who basically know about all of their techniques, etc. On the basis of this joint discussion internally with the management, all of these factors are considered, and which becomes the basis for creation of a provision. All right, clear on this? Yeah. So both these factors, one is past experience and second is future expectations. Both of them are important and relevant for the purposes of determination of any of the provision amounts. Clear? Clear on this? At times, it may also be possible that the management is not competent enough to assess this. The technicalities which are involved, which is required for making the provision, is not available in-house with the management. May not be too technical, but still the competent team is not available with the management, or it may be very, very technical for the management to determine. For example, if we talk about decommissioning liability, I'm sure you've heard about this decommissioning liability in the last session as well as when you would have covered India 16. Decommissioning liability is a very, very significant liability in respect of oil and gas companies. For example, companies like ONGC, etc. Very, very significant liability analysis in respect of decommissioning liability. And this assessment of decommissioning liability is not possible for the company to do. They require third-party consultants. Okay, a significant cost because is involved in terms of the amounts which will be spent. That's why they also need a significant involvement of third-party consultants, a significant involvement of their internal teams for the purposes of estimate of that decommissioning liability. Yeah. Similarly, in respect of provisions for warranties, many times we get to see that many of the companies get this valuation of provision of warranty through an actuary. So there are actuaries who are available who would help on this assessment. Okay, clear? So now, moving further, we can pick up this example number 26. Another small example, an entity is required to replace a major component of an asset under warranty. Each time replacement costs 1 million. From experience, there is a 30% chance of single failure, 50% chance of 2 failures, and a 20% chance of 3 failures. So what is going to be the most likely outcome? The most likely outcome is 2 failures, costing. So in case there are 2 failures, so it will cost 2 million. The expected value in such a scenario will be what? So we understand it's a single failure. If it's a single failure, then what's the cost? 1 million. So if it's a single failure, cost is 1 million. So 50% chances are cost is going to be 1 million. 50% chances are cost is going to be 2 million. And of course, 20% chances are cost is going to be 3 million in case of 3 failures. So all in all, what will happen? The expected value supports the provision for the most likely outcome of 2 million. Okay. Okay, now moving further. Moving on to another element which is required to be considered while creating a provision, and which is something which you should also expect to be considered in the exam. Because in the exam, if you expect questions from this particular topic, this element is most likely going to be included in the question. This element is called as present value. And this is something which you have considered significantly when you would have covered in the AS 109. Correct? Present value. I'm sure all of you are familiar with present value. Can you please quickly confirm if there is any doubt in relation to present value? Now, how is that present value going to be applied over here? We'll discuss. But as regards to present value, it's mainly how is that required to be applied to any scenario. Are you all clear on that? Quickly, Meena, I think we can go to this query slightly later. It's now present value. Quickly, are you all familiar with present value? What do you mean by present value? Otherwise, I'll just take you through the present value. Quickly, all of you please confirm. Or maybe if you want to share, please share your understanding of present value. So what do we mean by present value? How is that really relevant? Where is that required to be applied? Where have you considered so far in terms of the topics that you've covered? Quickly, please share your understanding of present value. Okay, Manan and Vijay is saying yes, we know, very good. But can you please share your understanding of present value? How do we apply? Where do we apply? Which are topics you have considered present value into? And is there anything in relation to the provisions that we have discussed so far where you have already considered present values? Quickly. I'm waiting for response. Quickly. Should I say future value is discounted with an appropriate discount rate, which is good. And where have you applied this so far? Any of the topics related to provisions where you would have considered this? Yes, I'm waiting for a response. Parag is saying present value is the time value of money. Very good. And that becomes the basis for considering. Jenny is saying it's the discounting, it's about discounting of the future cash flows for time value of money using a discount rate. Great. Vijaya, Kalyani, Surya, they're all giving the same answers. Great. You have not been able to tell me the topic where you would have considered this, but I'm sure when you would have considered financial liability under Ind AS 109, you would have applied present value concept. Correct? Now, in relation to provision, let's understand why do we need this present value. We understand that the provision that we are going to create is not really related to the current period. Why? Because this is something which is uncertain. This is something which is going to arise in future. Okay? Now, for this future, what do? We are estimating an amount. For the future, we are estimating an amount. Now, there are two ways to consider this. First, either we estimate the current value so we are on this date, either we estimate the current value, or what's the other method? Other method is to estimate the value or the amount that will arise in future. That means on this date. Generally, it will not be possible for us to assess this amount on current date. No. And that will also not be the right method to do this. The right method will be to estimate the amount that will arise in future. That means on this date. on this date, the amount that is going to arise. Yeah. And because this is a future date, so that's why what do we need to do? We need to bring it to today's date. Yeah. And the moment we bring it to today's date, what is required to be done? Present value is required to be computed for this. Yes or no? Yeah. Because for any of the future liability which we have determined for a future date, what we need to do, if we have to recognize it today, we need to know its present value. Otherwise, the amount will go incorrect. Yes? Correct? Okay. So let's suppose we are talking about decommissioning now. And let's suppose this is after 5 years. Let's suppose we estimate this amount to be 1000. 1000 is the amount that will result after 5 years. Now what do we need to do? We need to compute its present value. So let's suppose its present value comes out to be rupees 700. Please don't go into the computations. Please don't go into the usage of the discount rate by me. It's only illustrative. I know you know the concept, but still, for the purpose of provisions, there is just an element of present value which we need to discuss, and that is something we'll cover now. So let's suppose using some discount rate, the present value comes out to be 700. Now, as on today, what do we need to recognize? 1000 or 700? We will recognize 700. So, in the books of accounts, the amount that we record will be 700. But we know that the outflow which will result in future is going to be 1000. We know that in the books of accounts, we need to accumulate an amount equivalent to 1000. Only then we will be able to pay this after 5 years. Correct? So how do we do this? Year on year. Year on year. We need to accrete this liability. You understand the term accretion? In financial instruments, you have discussed this term accretion. What do we mean by accretion? Interest will be built up in this liability amount. Or you can say in this provision amount. Year on year, interest will be built up. Because of which, what will happen? This liability will go up. So let's suppose after 1 year, this liability becomes 770. Again, illustrative. Please don't go into the numbers. Let's suppose after 1 year, this liability becomes 770. Let's suppose next year, this liability becomes 850. So on, this will continue over a period of 5 years in such a way that at the end of 5 years, this liability of 700 or this amount of 700 will true up to or will accrete to 1000. Okay. Now for doing this, what do we need to do? Two things. First step is discounting of 1000 to its present value using a discount rate. So we'll need a discount rate. Number one. Number two, using the same discount rate. Now we'll not change this discount rate. Using the same discount rate, we will accrete this liability year on year. Yeah. Now, when we accrete this liability, what do we do? This sorry, this amount will increase year on year. So let's suppose we are on the end of year 1. So this is year 1 end. Now we understand that the amount of provision has gone up. So what is the accounting entry will pass? To provision. To provision. So the provision has increased by rupees 70. Provision is a liability. This has increased. So we are increasing the amount of provision by 70. From 700 it has become 770. Where do we take the other component? Can any of you tell me where do we take this other component? For completing this accounting entry quickly, I'm sure all of you would know this. Can you tell me where do we take this other component? Quickly. Yes, where do we take this other component? Where would the impact go in terms of increasing the amount of provision year on year? Quickly, year on year, when we increase the amount of provision, where will the impact go? One impact goes to the balance sheet, which is provision. Where do we take the other impact? Yes. Tell me, I'm waiting for response. Okay, great. Vijay is saying still go to interest expense. Very good. This will be a finance cost. So we'll say finance cost debit 70 rupees to provision. And why do we call it as finance cost? Because it's all about time value of money. What is the 70 indicating over here? This 70 is nothing but the time value of money. Why? Because year on year, what has happened? An interest element is getting accumulated over this. If this 70 is nothing but the time value of money, which should go and sit in the finance cost as interest. Correct? Yeah. Similarly, next year, same entry will be passed. So year on year, finance cost will arise, and which will result in this amount of provision going up to 1,000 by the end of 5 years. Okay, clear? It's the same type of accounting which you have seen for financial liability, which are measured at amortized cost. Yeah, if you can just try to correlate this, this is largely same, correct? So Jamin, Kalyani, Shraddha, they are all same. So it should go to P&L, another same should go to P&L. Yeah, Shraddha is saying it's interest because of discount. Very good. Now, please remember that in case of provisions, that means under Ind AS 37, provisions are required to be computed at present always, except in case the amount is immaterial. Let's suppose if we believe that by computing the present value or by not computing the present value, the impact will not be significant. It will not be material. Only in that case we make notes. Yeah, because materiality is something which is pervasive, so that applies over in relation to any type of provisions or any type of transaction that we require. Otherwise, provisions are required to be discounted. Okay, clear? Now, the next question which may arise for all of you is about the discount rate. Now, what is the basis for this discount rate? This discount rate is generally pre-tax, means before considering the tax. It's the pre-tax discount rate, and it's the same basis that you would have seen in case of financial instruments. The basis is all the same. Yeah. The only thing that you need to consider is that when you consider the discount rate which is pre-tax, the cash flows which are attached should also be pre-tax. Yeah, because if we are considering the cash flows, what are the cash flows? This 1,000, 700, 770, all of these are cash flows. So these should also be pre-tax. Okay, the basis should remain same for both. Those should not change. Yeah. We can now move on to some illustrations to discuss this further. Okay, so moving on to illustration number 7. X Solar Power Limited, a power company, has a present obligation to dismantle its plant after 35 years of useful life. So it's the dismantling obligation, asset retirement obligation. X Solar Power Limited cannot cancel this obligation or transfer to third party. Means this obligation is unavoidable. This will arise for sure. Yeah, this is something which is unavoidable. X Solar Power Limited has estimated the total cost of dismantling at rupees 50 lakhs. And its present value is also given in the question 30 lakhs. Now please understand that for you, this discount rate will be available in the question. Present value may not be available. You may have to compute this. It's by chance that both the amounts are available, but the discount rate will be available. Total cost of dismantling 50 lakhs, present value 30 lakhs. Based on the facts and circumstances, X Solar Power Limited considers the risk factor of 5%. That means the risk that actual outflows would be more than the expected present value. Okay. Now, how should X Solar Power Limited account for this obligation? Now, in this case, there's an amount of 30 lakhs of outflows which is given in the questions. So we understand that today, if X Limited has to consider the outflow amount, what's the outflow amount? Expected amount of outflow is rupees 30 lakhs is given in the question. So it's the present value, so we consider the present. With that, I will come to you for you. Further, the question says that there is a risk factor of 5%. So there is a risk which is attached to it. What's the risk? That actual outflows are more than expected present. Or you can say there is a chance that even though management is estimating 30 lakhs as the outflow, they may increase by 5%. So this is 5% that outflows increase. 5% chances are outflow increase. Okay. It's a risk which is attached to this type of event. Now, in this case, what does the standard require? Some of the things that we have discussed about the measurement have been the present value, past experiences, future expectations, uncertainties. We understand that the provision is based on uncertainties. Now, with the uncertainty comes the risk. The moment we say there is an uncertainty, a risk gets involved. What's the risk? Risk of outflow. Now, the estimation, therefore, whenever it is involved, has to consider the risk factor which gets attached to it. And whenever we have such type of risk factors, we have to take the regard of all of those factors while determining the amount of provisions. Therefore, in the given scenario, what do we need to do? In the given scenario, the amount of provision that will recognize will have to be 30 lakhs plus this 5% factor which needs to be considered. So this will therefore become 30 lakhs plus 5% of 30 lakhs. Can you tell me what should be the answer? What should be the answer? Quickly. $51.5 lakhs. Okay. 31.5 lakhs. Namita is asking, sir, why we are considering most likely in example number 26. Earlier, we are considering all the scenarios. See, that depends on the situation. If we are only looking at the most likely, then we'll pick up that. So the question will specify. Okay, very well. Okay, clear? Okay, so moving further, we can pick up this next illustration also. Illustration number 8. The grade and received responses from Kalyani, Shraddha, Mana, Pradhan, Vijaya. I would suggest if all of you can start with illustration number 8 piece on your own. I am also solving this, but it will be great. You can also start with this. Okay? Yeah? Namita has also on this. Great. ABC has an obligation to restore the seabed for the damage it has caused in the past, and it has to pay rupees 10 lakhs cash on 31st March X3 relating to this land. On 31st March 2006, it has to pay 10 lakhs. The management of this company considers 5% as the appropriate discount rate. So discount rate is available. Discount rate given in the question is 5% for all. Time value of money is considered to be material. So they are saying that the impact of discounting will be significant. So you should not take a stand that this is immaterial. And you should also remember that in the exam, you should not take a stand that the impact will be immaterial and hence ignorance. Don't take this stand. This is not advisable. Okay. This again, which is a concept which will apply in practical life. But in the exam, please don't apply this concept. Calculate the amount to be provided as at 31st March 2000 for the cost of restoring the seabed. Okay. So you are required to compute the amount of provision as at 31st March X1. Let's quickly first start solving this. I think Kalyani has already solved this. Very good. 9,07,000 is the amount. Parag has also solved this. Shraddha is asking, sir, in illustration number 7, why is not capitalized? Why didn't we capitalize asset retirement obligation as per India 16, which is required to be done? Why is this considered to be a liability? Please tell me. See, Shraddha, there are two things which you are mixing up over. First is the component which is related to asset retirement obligation, which is a liability. And the second component is about its impact, which either goes to P&L or is capitalized. Okay, let's understand this. Let's suppose if you create a dismantling obligation or asset retirement obligation. India 16 requires you to capitalize this as a component if this is related to an asset. Okay? If this is related to an asset. That is what India 16 requires. So in such a scenario, what would you do? You would capitalize this with the cost of asset. So what would you do? You will say PP debt. PP will be debt. Right? But what is the other accounting part in relation to this component of ARO which will capitalize the PP? Of course, a liability will have to be created. So we'll say, no, ARO. Yes or no? Yeah. So in this illustration, only this aspect is being considered. This part has not been considered. Very simple. Okay. And it's not necessary that this will always go to PP. This will go to PP if this is related to the asset. If this is not related to the asset, this will not go to PP. Okay? Clear on this? So in this illustration, only this aspect has been discussed. Fine? Okay, moving on to the solution now. Illustration number 8. You can see Mohan has also solved this. I'm sure many of you have solved this. So we have this discounting factor of 5% for second year as on 31st March X1. Using this rate of 5%, what do we get? One divided by 1 plus 5%, 1.05. Raised to the power 2, you get 0.9. Something which is available in the question itself, so I'm just picking up from the question only. Yeah. The amount of provision will be what? This is the PV factor which we need to consider for 10 lakhs. So 10 lakhs into this PV factor. And what is that? 0.9. So what do we get? We get these 9 lakh 7. Shraddha is clear on this. Okay. I'm not discussing the entire part. I'm sure you will be able to to look into the remaining part. Now moving further, as we discussed that while creating a provision, it is very, very important to consider the future expectations. In one example, when we looked at various probabilities under various scenarios wherein the historical pattern was available, we discussed that how the future expectations may change the probabilities or may change the scenarios. Right? Now that aspect is very, very important, which is required to be considered. And as we have discussed, that part is again something which is technical in nature, it is judgmental, and which requires involvement of the technical team or at times experts by the management, and on which we won't be required to do. We won't be required to assess that for the purposes of examination. For the purposes of examination, all of this assessment would be done and the fact pattern would be available to us. We'll have to just simply use that fact pattern. Correct? Yeah. But having said that, if the fact pattern is available, then we cannot ignore the impact of any of the future expectations or these future events while computing the amount of provision. So that is very, very importantly required to be considered. Okay, yeah. So let's move on to this illustration number 9 now to understand about this. X Chemicals Limited engaged in the chemical industry. So the company is into chemical industry, causes environmental damage by dumping waste in the river near its factory. It does not clean up because there is no environmental legislation requiring cleaning up, and the company has been causing this damage for the last 40 years. Yeah? So legally, there is no obligation on the part of the company to make good this damage which they have been doing. As of 31st March X2, state legislature has passed a path-breaking legislation requiring all polluting factories to clean up the river water already contaminated. Okay, so new legislation has come which requires the companies to consider this and to ensure that the cleanup is done well. Now, please understand that if you look at the past history, will the company require any estimate for this cleaning up? No. Why? Because there was no mandate. Company was not doing this on their own. So there was no kind of constructive obligation on the part of the company. And legal obligation did not exist. But now, going forward, in future, will the company be required to do that? Can the company avoid that? No. So irrespective of what has happened in the past, company will have to create a provision for this. Yeah. The formal gazette notification of this new legislation is still pending. Okay. How should X Chemicals Limited deal with this situation? So there's a slight problem over here. Even though the state legislature has passed this regulation, still this has not been notified. Now, considering the fact that this new law is yet to be notified, as at 31st March X1, sorry, 31st March 2002, what is the company required to do? All of you want to share your thoughts without reading the solution? What should the company do in this scenario as regards this amount which will be spent in cleaning up the river water? If you remember, similar type of situation was discussed in the last session also. What do you think should be the accounting treatment over here? How do you think it should be dealt by the company? Quickly, all of you, tell me what should be done over here. How would you deal with this? How would you deal with this? Do you think in this scenario provision will be required to be made? The answer is yes. In the last session, we discussed that obligating event will arise on the basis of past activities. So in this case, what's the obligating event? Contamination of water, which has already taken place. So contamination is already done. And it's only the administrative thing which is required to be completed, and that is about notification in the Gazette. Otherwise, everything is all done. So we understand that it's all firm, it's all firm up, it's all virtually certain that the legislation will be passed, because of which outflows will be required to be made by the company in respect of this cleaning up of the river. So therefore, the company should create a provision in the books of accounts as at 31st March next year. Shraddha is saying, sir, here if the legislation requires to clean up only after the law enacted, not for the river polluted within the USI, then it will not become a past event and the entity can avoid the obligation. Am I correct? See, generally this will not happen, because generally whenever any such legislation, any law will be passed, please try to understand the rationale. Why would any law be passed? Law will always be passed to make good something which has already been done. It's not something which is preventive in nature. Some destruction has already taken place, because of which new law will arise. And new law will always mandate whatever destruction has been done to make good that destruction. Even if we say that contamination which has already occurred, let's suppose if that doesn't become a liability on the company to make good that contamination, right? Because that has already been done. Please consider the fact that this is going to continue in future, isn't it? Because if the company has to run its operations, then this contamination will continue, and because of which cleaning up will be required to be done. Yeah, clear. So anyways, when you say that this obligation can be avoided if this is not related to the past acts, this will not really be logical. Kalani is saying yes, the provision should be given. Naveen is saying provision will be made. The same is the response from Vijay. Very good. Yeah, all of you clear on this? Any more questions, any more doubts if you have on this, please let me know. Otherwise, we'll move further. Any questions? Can we move further? All right. Expected disposal of assets. At times, it may happen that the assets are disposed of. And when the assets are disposed of, they result in a gain. So the question is, do we adjust the gain which arises on disposal of assets with the amount of provision? The answer is no. both the things have to remain independent. Both the things should not be attached to each other in a way that the accounting is done on a net basis. So that means both the transactions, creation of provision and recognition of gain on disposal of asset, should be recorded on gross basis, should not be netted off. Yeah? So let's look at this small example to understand this accounting treatment. Example number 27. If you all can move to example number 27. At the end of 2000X1, an entity is demonstrably committed to the closure of some facilities, having drawn up a detailed plan and made appropriate announcements. The expected impact of the plan is as follows. Committed closure costs because of this closure which will arise. So let's suppose entity is doing away with some facilities. So for doing away with those facilities, some closure costs will arise. So what do we need to do with this? Those committed closure costs needs to be recognized. Those are the costs they need to be recognized as a provision. So 10 lakhs is the amount which need to be recognized. In the question, the discount rate etc. is not available to us. So we are assuming this amount to be its present value only. Yeah. And the solution also says ignore discounting for the time. So what's the amount of provision at the end of 2000X1 that we create? 10 lakhs. And this will be recorded on a gross basis. Now from this closure, certain PP which was attached to this will get sold off, and that will result in a gain of 2 lakhs. Gain on sale of PP which was attached to this, you can say, operation, will result in a gain of 2 lakhs. Now the question is, because it's the gain and it is arising on the items of PP which is related to the same operation, same line of business, so can we just net it off because it's a gain at its cost and record a provision of rupees 3 lakhs instead of recognizing a provision of 10 lakhs and recording a gain of 2 lakhs? The answer is no. The gain is required to be recorded in accordance with the standard which is applicable on this. And which standard will become applicable on this? In AS 16. Correct? Similarly, this provision has to be recognized on a gross basis. This provision cannot be netted off. So this provision will be recognized in accordance with AS 37. So both of them have to be kept independent. We cannot net it off. So in the exam, please take care of these type of scenarios or these type of situations. At times, the question may include these facts, and the question may also specify that these are very much linked to each other. These are closely linked events and basis which management has already netted off. Yeah, this type of fact pattern may be available in the question. Don't get confused. Both of them have to be kept independent and both of them have to be recorded on a gross basis. Okay, clear? Any questions so far? Any doubts in case you have? Please let me know. Yeah, any questions, any doubts? All right, so moving on to the next principle now, reimbursements. Now, what are reimbursements? Reimbursement means we have incurred some expenditure, let's suppose on behalf of somebody else. And now we are asking that money or that actual amount spent from that person. Let's understand the meaning of this. Say there are two parties, A and B. An amount was required to be spent by A, equivalent to rupees 100. Whose expenditure is this? Of rupees A. But this amount of rupees 100 was spent by B. B spent this amount on behalf of A. B spent this amount on behalf of A. Now, when B will spend this amount on behalf of A, what will happen? B will ask this money back from A. So A will pay to B rupees 100. So this rupees 100 is what? This is nothing but the reimbursement. So similarly, for provisions, certain situations may arise as regards the reimbursement. And I would suggest all of you to start referring to this table which is given on page number 9.111. Okay. On the basis of this table, we will discuss all of these situations and we will understand what should be the accounting treatment in case certain reimbursements are required to be made. Okay. Before that, I'll answer the query. One is asking, so what should be the journal entry of committed closure cost? Very simple. So there is a provision which is required to be made. No provision for committed closure cost. This was 10 lakhs and this will be P&L debt. Very simple. Okay. So 10 lakh goes to P&L and provision for committed closure cost is created. Clear? Okay, so let's go to this table now. Situation number 1. Entity has no obligation for the part of expenditure to be reimbursed by the other party. When the entity, now we are looking at it from entity's perspective. So let's suppose we are talking about entity A and this is entity, this is entity B. Okay. Entity has no obligation. Which entity we are talking about? A. A has no obligation for the part of expenditure to be reimbursed by the other party. Who is the other party? B. Now in this case, what do we do? Entity has no liability for the amount to be reimbursed. Hence no provision to be made. Now, if we look at entity number A, can we say entity has got any obligation? The answer is no. So, if there is no obligation, do we need to create a provision? Not at all. Okay. Yeah. Let's move on to situation number 2. When we discuss all of these 3 situations, you will also get more clarity. Yeah? So let's get through with all of these 3 situations. Situation number 2. When some or all of the expenditure required to settle a provision is expected to be reimbursed by other party and reimbursement will be received. Now, entity A will receive the reimbursement if the entity settles the provision. Now, who is required to settle the provision? This entity. So, if this entity will settle the provision, so what will happen? they will have some outflow of resources, and for which entity A will get reimbursement from entity B. Why? Because this has been incurred, or this has been spent, this has been settled on behalf of B. So in this scenario, what do we do? Reimbursement is recognized as a separate asset in the balance sheet. In the P&L, expense relating to provision may be presented net of the amount recognized for reimbursement. Amount recognized for expected reimbursement shall not exceed the liability. So let's understand one example for this. Say entity A incurs a cost of ₹100. Okay. Okay. Now, for this ₹100, entity knows that it's incurred on behalf of B, or I should say, out of ₹100, 40 rupees is incurred on behalf of B, and which will also be reimbursed by B. And this ₹40 will also be reimbursed by B. Correct? So now, let's see what should be that amount. So entity will say expense debited ₹60. Entity will record an expense of ₹60. Why? Because out of ₹100, 60 is the cost, but 40 is not the cost. Instead, 40 is an asset. Why? Because this 40 is recoverable from entity B. So this will not be a cost. Correct? Yeah. So the amount of provision actually which has been recognized by entity A is what? Is 60 only. So the impact to the P&L is not ₹100. Why? Because what's the expense? What's the amount which has been incurred by A? Can we say it's full 100? No. It's netted off. It's netted off with the amount of reimbursement. Understood? Clear on this? Clear on this part? If you have any questions, any doubts on this, please let me know. Okay? Yeah? Moving on to the third situation. Where some or all of the reimbursement, where some or all of the expenditure required to settle a provision is expected to be reimbursed by another party, but the reimbursement is not purchased. Let's suppose in this situation number third, again there is a cost of ₹100. Okay, but out of ₹100, ₹40 is incurred on behalf of entity. But there is a problem. Even though ₹40 is incurred on behalf of entity B, for which entity B will also reimburse. But the problem is this reimbursement is not sure. Entity A is not sure whether they will receive the reimbursement or not. Okay. The surety is missing. We are not very sure about it. Virtual certainty is missing. In this scenario, what will this entity A do? Can the entity A pass this type of accounting entry? The answer is no. Why? Because when this asset was recorded, this was recorded with an understanding about recoverability of amount. Correct? This was done with an understanding of recoverability of amount. But now, as regards the recoverability of amount of ₹40, there is no virtual certainty. So in this scenario, what should this entity do? This entity will record this entire amount as an expense. Jamil is asking, sir, can the entity show both the expenses? Both the expenses means There is only one type of expense we have discussed. If you are getting confused on the other type of expense, there is only one type of expense. Or maybe we can just clarify on your query. Okay, all of you clear on these three situations now? Any questions, any doubts? If you have on these three situations, please let me know quickly. If you have any questions, any doubts on these three situations, please let me know. Yes, I'm waiting for your query now. Any questions? Yes, you have. All clear? All fine with this? Yeah? Okay, perfect. So then we can move on to illustration number 10, which is based on this, and this will only help you to understand this concept in a better manner. This is illustration number 10. Manan is asking, sir, this reimbursement is an obligation for the company, entity B is the creditor. Entity B is a debtor for entity number A. Okay, it's not the creditor. Because A is incurring on behalf of B. Clear? A is incurring on behalf of B. So that's why A will receive from B. In our examples, Namita and Parag are asking for explanation of these two situations again. So I would suggest let's get done with this illustration number 10. Hopefully with this you should get more clarity about this principle, and then if required we can go back to all of these three situations once again. Okay, after this illustration. Fine. X Beauty Solutions Limited is selling cosmetic products under its brand name B, but it is getting its products manufactured from Y. So there is X and Y. Y is doing the manufacturing for X. It has an understanding, that means an agreement with Y, that if the company becomes liable for any damage claims due to any injury or harm to the customer of the cosmetic products, 30% of the claim will be reimbursed to X by Y. So Y will reimburse 30% to X. During the financial year X1, X2, claim of 30 lakhs became payable to the customers by X. How should X account for the claim that becomes payable? Yes. Now, in the given scenario, an amount of 30 lakhs, is the total cost. Now, if you look at X, what is the total amount which is required to be spent? 30 lakhs. But out of this 30 lakhs, 30%, that is 9 lakhs, will be received from Y. Will be received from Y. Correct. 9 lakhs will be received from Y and remaining 70%. That is 21 lakhs. Who will bear this 21 lakhs? This will be borne by X. Correct? Now, tell me one thing. If X has to record an expense, if X has to create a provision, what will be the amount of provision that it should create? Tell me. In terms of P&L, I'm saying. Now, if today X says that X is required to spend some amount in its P&L, what is the hit? Should we say it will be 30 lakhs or should we say it to be 21 lakhs? Kalyani is saying the claim amount should be 21 lakhs. Meena is saying expense should be debited by rupees 21 lakhs. Okay, I would suggest if Namita Parag can also attempt this. Bhargavi, if you can also attempt this quickly, can you tell me? Just forget about these reimbursements. Just think logically. It's a very, very simple situation. Just think logically. What do you think should be the amount which X should record as an expenditure? Quickly. Tell me. I'm waiting for the response from all of you, particularly Namita, Parag, Bhargavi. If you can answer this quickly now. This will help you to get more clarity on the situations that we have discussed. Quickly now. Shweta is saying the expense should be 21 lakhs. Very good. Tell me quickly, what should be the amount of expenditure? Can we say it will be 30 lakhs or should we say it will be 21 lakhs? Okay, Namita is saying 21 lakhs. Madan is also saying 21 lakhs. Very good. Bhargavi, I am waiting for a response. Okay, now let's look at the expense for X. Even though X will pay 30 lakhs, means cash outflow, even though it will be 30 lakhs from the books of X, X will receive 9 lakhs from Y. So that means P&L hit to X will be what? 21 lakhs. So what's the amount of expense which X should record? So in the books of X, what should be the amount of expense? 21 lakhs. And this 9 lakhs will be a receivable from Y. So we will say receivable from Y debited 9 lakhs to bank if this amount is already paid, or to liability towards customers, whatever be the situation. Correct? Yeah. So it's a simple situation or not? Now you can go back to the situations that we have discussed. In the situations, it was the same thing. There's no change. Correct? Clear on this? Surya has also got the same answer. Parag is giving the same answer. Shraddha is also saying it to be same. Very good. So I think only Bhargavi has not answered. Bhargavi, are you clear on this part? Yeah? Clear on this part? Quickly? Okay, great. Bhargavi has also given the same answer. Vijaya is also giving the. Okay, Vijaya is saying X has obligation for 30 lakhs. I believe company should provide 30 lakhs. No. See, X will have an outflow of 30 lakhs at once. But out of this 30 lakhs, 9 lakhs will be paid by whom? Y. or you can say reimbursed by Y. So in terms of the P&L hit, can it be 30 lakhs? No. Expense of X is what? Only 21 lakhs. This 9 is a receivable, recoverable, you can say reimbursement from Y. So it will not be expense. Clear? Yeah. So what we can do is, because we have stretched this session a bit, so let's take a quick break of 10 minutes or 5-10 minutes. Huh? After the break, we'll just quickly recap all of these three situations. In the meantime, I would also suggest you just go through these situations once again. When we meet after the break, we'll go through these situations once again and we'll also continue further with that discussion on the topic. Alright, so let's take a break. Ram? Ram? Alright, yeah. Okay, so now moving back to your queries, so I can see some of your queries on this. Shraddha is saying that the balance sheet provisions must be recognized as net of 30 minus 9 lakhs. No, in the balance sheet, if you will see, liability or the provision is full amount. But in the P&L, it's 30. Okay. Namita is asking, so how do we measure virtual certainty? In the question it's specified, but otherwise how do we measure? See, in the question you have to just go by the terms. Generally, it will be specified whether it's virtually certain or not. Otherwise, you can also go by the term. For example, when there's a contractually bound arrangement, wherein definitely we are certain that the money will be recovered. However, if this is not something which is backed up by a contract, or the question has this language that there's no clarity as of the recoverability of the amount, then in such a scenario you should assume that the virtual certainty will not exist. Okay. Then I think next query is from Jamin. Jamin is saying, can it be shown separately in the? Of course, this will be shown in the P&L separately. And this is something which doesn't go to the P&L, this only goes to the balance sheet. Okay? All of you? Vijay seems to be clear on this. Great. So now I will go back to those three situations. If you are not clear on this, can you all quickly confirm if you are clear on this? That's fine. Otherwise, I can go back to those three situations. Or I'll just do a quick recap. So I'll just go it other way around. So the third situation, I'm just reading it. It says, where some or all of the expenditure required to settle a provision. Means where the amount which is settled is reimbursed by third party or is to be reimbursed by third party, but it's not virtually certain. So do we record an asset for the reimbursement? The answer is no. Situation number 2, where an amount either partly or fully, which is spent by party 1 and which will be reimbursed by third party, and that is virtually certain. So the amount which is recoverable from second party will be recorded as a reimbursement asset. Yes, that is second situation. Situation number 1, when the entity doesn't have an obligation to settle this obligation or to settle this amount for the third party. So do we recognize the provision at all? No, that's the first situation. All of you, now I'm hoping you are clear on this. Yeah? All of you, now you're clear on this? Quickly. Now you're clear on this? Great. So we now move further on to the next aspect related to changes in provisions. As we all understand that we've been discussing about provisions here. Provisions are all approximations. By provision, we need to say that uncertainty exists. Amount is not fixed, amount is not certain, and that's why this is subject to changes. So it is very much possible that something that we have estimated today changes in future. Or liability on an amount which we are expecting to pay, let's suppose 5 years later, doesn't come out to be the same amount which we have expected. It may come out to be a different amount. And year on year, this expectation will change. Yes? Yes or no? Now, how do we deal with this? First of all, standard requires a mandatory review. First of all, standard requires mandatory review of all of these provisions that we create at every reporting date. So that if there is any change required in this provision, that is made. And whenever any change is made, the impact has to be considered prospectively. It will not be retrospective. So let's suppose for a period of 5 years, provision has been estimated. Let's suppose today we estimated the amount of provision to be 1,000. Let's suppose next year this changes to 1,010. Now this changes because of the basis, because of the judgment, because of the facts which may have changed, because of the developments which might have taken place. Now the question is that this change which has arisen in terms of the estimate, how do we deal with this? Do we start considering it from day one? No. We start considering it from the day this has changed. Until unless it's an error. If we believe that this amount in itself should have been 1010, this was erroneously assessed, then of course it will be a different treatment of errors. But if this is something which was the best estimate on day one and which has now been updated to 1010, then the change in this estimate will be done prospectively. Okay, clear? Now, we can move on to example number 28. Very small one, simple one. Company X. Company X has made a claim of rupees 2 million for liquidated damages. This is the claim. Entity is disputing the amount of claim. Due to the uncertainty which is involved in the amount payable, entity recognizing this amount as a provision. So, a claim has been raised against the entity and the entity has provided this entire amount of claim as an expense. This is towards liquidated damages. After negotiation with the customer, so we have this entity and this is company X. Company X raised a claim for LD and the amount is 2 million. So this entity recorded a provision for this 2 million. Okay. Now, after negotiation with the customer, means entity negotiated this amount with company X. Amount is agreed at 1.5 million. After discussions, amount was changed. This was reduced to 1.5 million. Okay. As there is no uncertainty involved relating to amount payable, it no longer meets the definition of provision and should be reclassified to an appropriate category within the liabilities. Now, the moment this amount is changed, what do we need to do? We need to update this amount of provision to 1.5 million. Okay. Now, another situation is possible. Let's understand what is the other situation. Another situation could be the one wherein when this claim was raised against the entity, no provision was created for 2 million. Maybe this was shown as a contingent bond. So let's suppose instead of recorded as a provision, this was shown as a contingent liability. And now, after discussions, negotiations with the customers, what has happened? This amount has got firmed up and it's been finalized. Yes, that this amount will be settled at 1.5 billion. In which case, this should now be recorded as a provision, which was not done earlier. Okay. Now, in this scenario, if this was a contingent liability recorded earlier, means disclosed in the financial statements earlier, what do we do now? Now we create a provision instead of changing the provision, because it's not changing provision, it's a recording of provision now. Another situation which is possible. Let's understand. What's the third situation? Third situation is, earlier we recorded a provision. Earlier we recorded a provision of rupees 2 million. Why? Because of the uncertainty which was involved. Yeah. Now, when this amount is all firmed up, what do we say? Now all the uncertainties which are attached to this are gone. Therefore, this provision will not remain a provision anymore. This provision should get put up to a liability. Why? Because what is a liability? Liability is the one wherein the amount is certain, its timing is certain, which was not the case when it was a provision. So in this scenario, what will happen? Earlier there was a provision of 2 million, which will be reversed, and now a liability of 1.5 million will be recorded. So this will be the accounting entry. Provision debited 2 million. Okay. To liability 1.5 million. And the resultant impact will go to P&L. To P&L 0.5 million. So we can have three types of scenarios. In every scenario, you need to assess as to what should be the accounting treatment. Okay. Any more questions, doubts in case you have on this? No? Alright, so then I think we can move on to illustration number 11, or rather I would say you should mark illustration number 11 as your homework. It's all about changing provisions. I'm just hoping that you are doing the homework. Now, another thing about the provisions which we need to consider is about the future liabilities. We understand that provision is all about future liabilities, but for which assessment is done today. We are not recording the future liability today. We are just recording the amount of liability which is estimated towards that future liability as on today. So that means we are computing the present value. Yeah, this is the reason we are computing the present value. Please remember one thing, that by estimating the amount of provision, or by this concept of provision, we do not mean to say that all the future liabilities should be recorded today. No, that's not the requirement. That's not the intent of the standard. Okay, that's not the intent of the standard. That's not the expectation from the standard. Which means that if there are any future liabilities, or I'm using this term of future operating losses, that should not be recognized as a provision. All right. Future operating losses should not be pre-booked by us in the form of a provision. That will not be the right thing to be done. Okay, clear? Now, let's understand this with the help of this small illustration number 12. X Packaging Limited has two segments, packaging and paper division. They have got two divisions, packaging and paper. These are the two divisions that they have. In March 2000 X1, Board of Directors approved and announced a formal plan to sell the paper division in June 2000 X1. So they plan to sell this. When will this be sold? June 2000 X1. In March, a plan has been formed. Operating losses of the paper division are estimated to be approximately rupees 50 lakhs during the period from 1st April 2000 X1 to 30th June 2000 X1. So you can say 1st April X1 to 30th June 2000 X1. The period for which this division will continue, losses are expected to be rupees 50 lakhs. Because till the time this is operational, losses are going to arise. And that's why they are planning to discontinue this. Management wants to include this future operating loss. What is this future operating loss? Loss due to operations which will arise in future. Because we are standing on 31st March 2000 today. Management wants to include this loss in a provision for restructuring the financial statements for the period ended 31st March X1. Can X include these operating losses in a provision for restructuring? The question is, can these future operating losses be provided in the financial statements of 31st March X1? The answer is no. Why? Because these are future operating losses. The operations are going to be there in the future, so that's why when should these get recorded in future? Today, to record these expenses, just by saying that the management has planned a restructuring, there is no doubt that the management has planned a restructuring. There's no doubt about it. But that restructuring doesn't result in a cost of rupees 50 lakhs. This restructuring may involve certain costs, but this is an operational loss. This is an operational loss. And this operational loss has got nothing to do with this restructuring. And that's why it will be wrong to club this loss with this restructuring cost and provide for as at 31st March 2000 X. Okay, clear on this? Yeah. So let me just look at a couple of queries. Namita is again asking the same question. How do we measure virtual certainty? As I told you, this is something which will get more clarity on from the facts of the question. The moment question says there's a binding agreement, there's a contract, you should assume this to be virtual certainty. If any of these facts are missing, you need to give an assumption, or otherwise the question will specify that the recoverability is doubtful, etc. That is something where you will say the virtual certainty is missing. Okay. Kalyani was asking, so when it is certain in the case where contingent liability was disclosed earlier, should we create a liability or create a provision? Again, a nice question. This will again be dependent on the facts which are available. Let's suppose earlier this was contingent liability, and now this no longer remains a contingent liability. Why? Because this has become probable. But uncertainty is still involved. So the moment we say uncertainty is still involved, we will record this as a provision. But if we believe no, now this has got firmed up, and in terms of timing as well as amount, there is no uncertainty. Then from contingent liability, it may straight away jump on to become a liability. Fine. Then Shraddha is asking, sir, in example number 27 also, just go to example number 27. Okay. In example number 27 also, future costs were involved as the appropriate announcements were made, but provision was created. Is it so? No. See, there are a couple of things which are required to be considered. One is a provision. See, we have been discussing about provisions, right? And in terms of provisions, what are we discussing? We are discussing about costs, which are going to be incurred in future, but for which we create a provision today at its specific. And it's all cost which is involved. If you go to example number 27, it's a cost. Committed closure costs. That for closure, certain costs will be incurred. Understood? If we say this paper division is required to be shut, for shutting the paper division, let's suppose some costs will have to be incurred. What are those costs? Let's suppose employees will have to be retrenched. Yeah, they will have to, and company will have to pay some compensation to them. That is what? That's a cost of closure. There is another concept, and which is different from this, and that is about operational losses. This paper division is functioning today with losses. There are losses out of operations. And till the time this paper division will continue to run, losses will keep coming. So when we are talking about rupees 50 lakhs, we are talking about those operational losses and not the cost. Please differentiate between loss and cost. These two are different terms. So in example number 27, it was cost and not a loss. Clear? Yeah. Kalyani is clear of this. Surya is asking, so if restructuring happens due to certain events, those costs should not be discounted, but cost of restructuring should be discounted. Am I correct? See, for restructuring, I would suggest you can just hold on to your thoughts for some more time. Because on restructuring, we are going to have some more discussion. It's a separate concept which has been discussed in greater detail under the standard. So let us wait for that restructuring part to come. Then I'm sure most of your queries will automatically get resolved. Okay, let's wait for that. Huh? Okay, moving on to the next concept, that is about onerous contracts. I'm sure you must have heard about onerous contracts because this is the concept which also existed under Indian GAAP. Under accounting standards, onerous contracts existed, and its accounting treatment, which existed under accounting standards, is in line with what is suggested under India's also. Do you want to share some thoughts on onerous contracts? Any of you? Any of your thoughts on the onerous contracts? What do you mean by onerous contracts? How do we deal with onerous contracts? To build the accounting treatment of onerous contracts. Quickly, any of you want to answer that? On the onerous contracts. So let's understand the meaning of onerous contract. What do we mean by onerous contract? Let's suppose there's a contract from which certain economic benefits will arise. What are the economic benefits? Let's suppose revenue will arise. Okay. Let's suppose the revenue or the economic benefits which are expected from the contract is X. What is the amount of economic benefits which is expected out of this? X. So X is the benefit which we receive from this. This contract will not only generate revenue. This contract will also be involving certain costs. Yeah, for generating revenue, costs will also be incurred. Yes or no? Only then the revenue will arise. Now, let's suppose the costs which the company will have to incur to execute this contract or to generate this revenue is X plus 1. X plus 1. Okay. Yeah. Now, in this case, if we analyze this contract, will this be beneficial or not? What do you think about this contract? Do you think this contract will be beneficial to the company or not? What are your thoughts? Quickly, yeah. I think this is very, very simple for all of you to answer. What do you think about this contract? Will this contract be beneficial to the company or not? Yes or no? Quickly. I'm waiting for a response. What do you think about this contract? Will this contract be beneficial to the company or not? Okay. Radha is saying no, this will not be beneficial. Vijay has shared some thoughts on the onerous contract, I think. We provide in case of closure if they have initiated to not provide for planning. I'll come to this part just separately. Okay, now this is for sure that this contract is not beneficial. Correct? Now, if we think about the company, there's a way. What's the way which is available to the company to cancel this contract? Isn't it? If the contract is executed, what will happen? There will be a loss of 1. This will result in a loss of rupees 1. Correct? Or you can say rupees 1 crore, some crores. Yeah? This way out is to cancel this contract. If the contract is cancelled, can this loss be avoided? Yes, this loss can be avoided. And what's the way out? Very simply, just terminate the contract at the stage you get to know that the costs are exceeding the economic benefits. But there's a problem. So we have got first situation number 1, wherein we see that if the contract is executed, it will result in a loss. So we are stuck. That we don't want to execute the contract. Now what's the way out? To cancel the contract. Now if the contract is cancelled, there again we have got 2 situations. So this was situation number 2. cancel the contract. Under situation number 2, we have 2 more situations. That if the contract is cancelled, there is no penalty. Or you can say there is no termination penalty. Means for terminating the contract, there will not be any penalty. This will be the best scenario for the company. Why? Because just by cancelling the contract, they can avoid this loss of rupees 1 crore. So I'm saying the amounts are in rupees crores. The other option is, or the other scenario is, where the contract is cancelled, but if the contract is cancelled, there will be a termination penalty. Equivalent to rupees 25 lakhs. Equivalent to rupees 25 lakhs. Okay. Now, in the given scenario, if we stay on situation 1, then it's not beneficial. If we go to situation number 2, and our arrangement requires termination penalty to be paid if this is terminated before executing the contract, there again we are stuck in a way that in both the situations loss is incurred by the company. Definitely here the amount of loss will be reduced, but there's no doubt that this contract has given a cost to the company, or you can say unavoidable cost to the company. Correct? However, this case number 1 is the one wherein costs can be avoided. So the moment we have a situation wherein contract's execution gives us a loss, and even if it's terminated, it involves unavoidable costs like this. Okay, so we can say this plus this. Such a contract becomes onerous contract, and for which provision is required to be made upfront. Whenever we have such type of contract, that will be called as onerous contract, and for which this provision means lower of the amount of rupees 25 lakhs or rupees 1 crore, whichever is lower, is required to be made upfront. Means without waiting for the contract to get completed, standard says book this amount as a provision. All of you clear on this? Understood the meaning of onerous contract? Yeah? Understood the meaning of onerous contract? Now we can pick up one example to discuss about this. Illustration number 13. Then go to page number 9.6. Illustration. X Metals Limited has entered into a non-cancelable contract. Please understand, it's non-cancelable. The question will specify. Some of you may be thinking, sir, how do we get to know whether it's cancelable or not? Every time in the question, it will be known. To purchase 10,000 units of raw material at rupees 50 per unit at a contract price of rupees 5. Okay. X has a contract to buy, to purchase 10,000 units at the rate of rupees 50 per. So this becomes rupees. Correct. As per the terms of the contract, X would pay rupees 60,000 to exit the said contract. Because it's non-cancelable, so in case X would want to terminate the contract, termination penalty will be ₹60,000. In case it's terminated. So we're not saying it's into losses. We're saying in case it's terminated. X has discontinued manufacturing the product that would use the said raw material. So X was manufacturing a product earlier wherein this raw material was required, now it's not required anymore. Therefore, X has identified a third party to whom it can sell the said raw material at ₹45 per unit. So now, if you look at the scenario of X, this raw material is useless for X. But unfortunately, X cannot terminate the contract. Why? Because this penalty will have to be paid. So X has a way out. What's the way out? X can buy this from Y at ₹5 lakh and can sell it further. If X sells it further, there will be a loss of ₹5 per unit. Correct? So the amount of loss that X would incur will be ₹50 minus ₹45 into 10,000. So what's the amount of loss? ₹50,000. So what would X do in this scenario? X would buy this material from Y and sell this to a third party so that the loss of X is reduced to 50,000 from 60,000. That's the best payout available to X. Correct? But irrespective of the scenario X chooses, whether X chooses to terminate or not, in both the scenarios, this contract will result in loss. So the lower of these two losses is what? 50,000. Standard says that this ₹50,000 should be provided in the books the moment this contract is signed. Why? Because this is an onerous contract. Alright? All of you clear on this? All of you clear? Any questions, any doubts in case you have on this, please let me know. Because with this, we are largely done with the kind of provisions which were required, except for one specialized type of situation which is known as restructuring, on which we'll move now. Largely the type of provisions which were suggested by the standard are covered by us. So that's why, before I move on to the restructuring, if you have any questions, any doubts on this part, please let me know. Yes, quickly. Any questions, any doubts in case you have on this? Please tell me. No queries, so can we move further? Yeah. Okay, so now moving on to the restructuring. Restructuring, we have slightly touched upon this concept, but we have not discussed this concept into greater detail. And this is another very important part of the standard. Restructuring is something which is very, very common in the current scenario. And in the last few years, particularly, you should see restructuring is very, very common. Businesses quite often choose this option of restructuring. Namita is asking, sir, we need to recognize provision of 50,000 in the previous example. That's right. Okay. Now, let's try to understand what do we mean by restructuring. So let's pick up some examples. In one of the examples that we picked up, where the company had two divisions, packaging and paper. In such a case, let's suppose company is experiencing losses due to paper division. Packaging division is going fine, perfect. It's a profit-making division. But the other division is loss-making. So what would the company plan to do to hive off that division? To do away with that division. Okay. What do we call it as? It's a kind of restructuring. So you can say sale or termination of a line of business. Say a company has been manufacturing three products, product A, B, and C. Product A and B are into profits. C is resulting into losses and it's been continuing into losses for many years. Company doesn't expect any improvement in terms of profitability. So if the company plans to discontinue this product, that again is restructuring. Okay. Let's suppose a company has been operating at two locations. Say first location is Pune and second location is, say for example, UK. The offshore location, that means the international location, it's an Indian company, is into losses. And the company plans to do away with this. That again is what? Restructuring. Okay. Another type of restructuring could be in terms of the management. Let's suppose the company plans to restructure its organization structure. There are many layers of seniors in the departments. Company wants to do with that. Or the hierarchy which the company would have created, company wants to change it. Company wants to bring a change in terms of its senior management, where some of the employees will be made to move out of the company, some new hires will be made. That is again a type of restructuring which the companies enter into. Yeah. So there are different ways through which the restructuring may be done by the company. And any of these type of restructuring will involve a cost. Now, this is something which is important for you to understand. That why would restructuring involve a cost? Let's understand this. See, when the management is planning to restructure, it's not something which they have thought at its time. Certain legal compliances may be attached to it. Certain operational activities, you can say some internal activities may be attached to it. At times, some compensations may also be required to be paid by the management to the employees or maybe to the third parties for getting that restructuring completed. All of those costs which are incurred by the management in relation to execution of that restructuring is what? That is nothing but a restructuring cost. Right? That is nothing but a restructuring cost. Yeah. Now the standard says that whenever we have any sort of restructuring which is taking place, first of all, we should assess. Now, this is the most important point, because whenever you see questions in the exam, this is the point where you start. When should we create a provision? Means, when do we say that yes, restructuring has started, for which costs are now required to be provided for? Means at what point of time this restructuring gets triggered, which will result in a provision in the financial statements. Okay, clear? So let's try to understand. There are certain conditions which are given by this. First, management should have a detailed formal plan for restructuring. Management should have a detailed formal plan for restructuring. Only when they have a detailed formal plan of restructuring, we should say that yes, the restructuring has started. Now, what are the ways through which we can check that it's a detailed formal plan? Management would identify the business which is required to be restructured, the location which is required to be considered, the location, function, or the employees which will get affected. All of them need to be identified. It cannot be just a thought in the mind of the management. It has to be something which needs to be clearly identified, for which a proper plan should be drawn, and for which some sort of expenditure should also be incurred by the management. And the management should also have a plan. When would they execute this? Yeah, so that means a proper planning should have been done by the management, and it should be a formal process. It cannot be just informal. Formal means some meetings should have taken place, some identification should have been done. Yeah? And management should have a clear plan of getting this executed. Yeah. Second, there should be a valid expectation of those who are going to get affected because of this, that it will carry out the restructuring by starting to implement that plan or announcing its main features to those who are going to get affected because of this. Communication. Of course, if this restructuring is going to happen, there must be a communication from the side of the management to those who are going to get impacted. Let's suppose management plans to say carry out a retrenchment of employees. Say approximately 50 employees will be moved out of the company. Definitely management has a plan, detailed formal plan, very quickly done. But this communication is not made to those employees. This has not been discussed with them. This has not been communicated to them. A clear-cut plan has not been laid out, agreed with those who are going to get impacted because of this. Then once again, we cannot say that the restructuring has triggered. For this restructuring provision to be created, both these conditions are required to be fulfilled. Only when both of these conditions are fulfilled, we can say that yes, it's now something which is moving further and which can then be recorded. We can pick up a couple of small examples to get some more clarity about this. I think Namita has a query in between. Namita is saying, please explain point number D on page number 9.116. Expenditure will be undertaken. Expenditure means when you are doing these activities, so management will incur some expenditure. Let's suppose lawyer is required to be hired. So management will start incurring that expenditure. Okay. Certain internal activities are required to be done. So management will start incurring expenditure. Okay. For doing this entire process, costs will be incurred. So those costs should start getting incurred. That will reflect as if the restructuring has started. Otherwise, it will just be an idea, it's a thought. And for thought will not create a restructuring cost. Okay. Then I think question is a query. Provision is created on future loss, but provision should be on obligation. Question cannot clear on your paper. Maybe you can just elaborate on this point, please? Okay, let's go to example number 33. This is page number 9. On March 12, 2000X1, board of an entity decided to close down a division. Before the end of the reporting period, that means 31st March X1, decision was not communicated to any of those who are affected and no other steps were taken to implement this. It is assumed that a reliable estimate can be made of any of the outflows which are expected. Can we say that there is a need, or can we say a provision can be recognized over here? No. Why? Because what's the obligating event? Communication to those who are impacted. This could be in place, but this is not in place. So can we create a provision? No. Example number 34. Let's move on to this example. On March 12, 2000X1, board of entity decided to close down a division, making a particular product. On March 20, X1, detailed plan for closing down the division was agreed by the board. Means board has taken a decision. Letters were sent to the customers, warning them to seek an alternative source of supply, and redundancy notices were sent to the staff. So now the employees will be retrenched. Communication is made to them that you will be not required in the company from this date, and that's the plan of the management. Communication is also made to external parties that the management is planning to shut this operation. It is assumed that a reliable estimate can be made of any of the outflows which are expected. Now, in this case, are both these conditions fulfilled? Yes. So, can we say a provision can be created? Yes. And how will the provision be made? The basis will remain the same. It's going to be the best estimate. Best estimate looking at the conditions which are involved, which will result in outflow. Yes, so that has to be the best estimate. Okay. Clear on this? So these are some of the scenarios which one has to consider while creating a provision. There are a few things which are attached to this, which we need to consider. A restructuring provision does not include such costs as retraining or relocating contingent staff, marketing, or investing in new systems and distribution networks. Let's suppose an entity has got certain employees who are carrying out certain activities, but now those activities are no longer carried out by the company. Plans to change. Okay. Now, basis the change which the company is expecting, what will happen? Those employees will not be required. But the company is not planning for retrenchment of those employees. The company is planning to train those employees so that they equip some skill set with which they can continue with the company on some different activities. Now, such type of costs will not be considered to be a restructuring cost. Okay? Because restructuring is something which will bring end to the employees. But if those are retrained, that is something which is a common process, which continues within the organization. That should not be considered to be a restructuring cost. Similarly, marketing for promotions of the products or investments into new systems, new processes, development of new technology. All of these, you cannot say these are restructuring. These are not restructuring. These are different from restructuring. Yeah. So a difference should always be considered between what is going to be a development of a new activity or development of a new process as compared to what is going to be a closure of an existing activity. Okay, yeah, clear. So let's move on to another restitution now. Restitution number 14. I would suggest you can just start solving this on your own, and if you can answer this, you can start on this own. Don't wait for me to solve this one quickly. Without looking at the solution which is given in the question, all of you need to answer this, please. Illustration number 14. Okay. X Cements Limited has 3 manufacturing units situated in 3 different states of India. Board of Directors of X, in their meeting held on 10th of January 2000 X1, decided to close down its operations in one particular state on account of environmental reasons. Operations in state 1 to be shut. Board has taken a decision. Detailed formal plan for shutting down the above unit was also formalized and agreed by the board in this meeting, which specifies the approximate number of employees who will be compensated. Why? Because if those are moved out, they will have to be paid, and expenditure which will be expected due to this. Date of implementation of plan has also been mentioned. Meetings were also held with the customers, suppliers, workers to communicate the features of the formal plan to close down the operations in state 1. And representatives of all interested parties, all the parties which will get affected because of this, have been called upon, meetings have been held with them. That means communication to all the concerned parties have been made by the management very clearly. A detailed plan has been communicated to all of them. It's all done. To the actions of board of directors over here, create a constructive obligation that needs a provision for restructuring. Yes or no, and why? All of you, please. Tell me. Do you think this will result in a constructive obligation because of which provision for such restructuring will have to be created in the financial statements for the year ended 31st March next one? All of it. Tell me yes or no along with reason, please. Along with reason, please. Namita is saying yes, provision needs to be created, but the reason is missing. I need reason. Vijay is saying restructuring activities relate to end or closure. You can say sort of, yeah, generally in line with those activities. Quickly. Yes, all of you, I think it's a fairly simple one. You need to give me the reason. Why do you think that provision needs to be created? In the meantime, you should note down question number 3 and 5. In fact, remaining questions you can practice all, but question number 3 and 5 are your homework. I would suggest you to practice more, that will be good. But questions number 3 and 5, at least you should practice. Okay, quickly. What's the reason Why would you think provision needs to be created? Namita is saying because there's a formal plan for closure. Okay, so Riya is saying it needs to be created because there's a detailed plan. Meena is saying provision needs to be created as obligation arises when there's a detailed plan, and also a communication is there. Please remember, in the exam, when you will have such type of questions, you will have to put down both the conditions. If you don't put down both the conditions, you will lose marks. There are two conditions which are required to be fulfilled. One, detailed formal plan. Second, its communication. All right, clear? In this case, both the conditions are fulfilled. And because both the conditions are fulfilled, that's why what will happen? That's why it will be appropriate on the part of the management to create a provision for such type of restructuring in the financial statements. Okay? Yeah. Then I think Manan is also saying decision is made and communication is done. Vijay is saying the same thing. Kalyani has the same answer. Very good. So with this, we have almost completed the standard, but I think small part of the standard is still left, which we can cover in the next session. And in the next session, we'll also start with a new topic that is on share-based payments. Very, very important and interesting topic. And before I conclude my discussion for today, if you have any questions, any doubts that I missed out on, please let me know. We can have a discussion on that. Yeah, and then we can end our discussion. All of you. If there is anything that we need to discuss, any of your queries, any of your doubts, anything which I have missed out on, please let me know. We can discuss that before moving on to. Yes, any questions, any doubts in case you have on this? Some of your queries I remember we I think we discuss, we can discuss towards the end of the session. Please let me know if those queries still remain. Yes, all of you. Any doubt? No doubt? All clear? So I'm just hoping that you're getting the clarity around the concept. Yeah. So if this, what we can do is, if you don't have any further queries, we can just conclude our discussion for today. And still, if anything comes to your notice which you are missing on, you can just write down your query in the query box, and we can have a discussion of your query in the next session. All right? Yeah. So this, let's close our discussion. Thanks to all of you once again for your time and for your wonderful participation today. Thanks, everyone. Thanks so much. Yes, yes.